There's a moment in every market collapse where the smart money sees it coming and the crowd doesn't. January 18th, 2026 was one of those moments. While the internet was busy making memes about Greenland, something much quieter happened in the back offices of London's biggest bullion banks. Risk managers started sending emails with subject lines like urgent and halt all transfers. Trading desks that normally don't work Sundays suddenly had people on conference calls. And somewhere in New York, roughly 4.2 million ounces of silver that were supposed to be on a plane to London just sat there. Because a single tweet about buying a frozen island had just severed the logistical artery of the global silver market. Not with a sword, with a tariff. Let me show you what actually happened. On January 18th, President Trump announced a proposal to purchase Greenland from Denmark. The mainstream press treated it like a reality show subplot. Late-night hosts made jokes. European politicians gave outraged interviews. But buried in the same announcement was a single policy detail that most people scrolled past. A 10% tariff on imports from 8 European nations, including the United Kingdom, effective February 1st. And if no deal on Greenland was reached by June, that tariff would jump to 25%. To a casual observer, this looks like trade policy theater, political leverage, a negotiating tactic. To a derivatives trader at HSBC or JP Morgan, this was a hand grenade rolling across the trading floor. Because the United Kingdom isn't just another country on a tariff list. The United Kingdom is where the London Bullion Market Association operates, the LBMA, the single largest physical precious metals marketplace in the world. And silver, unlike most commodities, lives in 2 places at once. There's the LBMA in London, where the big physical bars move between vaults and sovereign buyers and ETFs. And there's the COMEX in New York, where futures contracts are traded and settled with paper, or occasionally with actual metal. These 2 markets are supposed to be mirrors of each other. Same asset, same price, different location. But they only stay synchronized because of one critical assumption, that you can move silver between them freely, cheaply, and without penalty. That assumption just died. To understand why this tariff is so destructive, you need to understand how the silver market actually functions behind the curtain. It's not like buying a stock. It's not even like buying gold. Silver is industrial. It's consumed. It's needed for solar panels, electronics, batteries, defense systems. But it's also a monetary metal held by central banks, ETFs, and private investors. This creates a strange tension, high demand, relatively low supply, and a price that historically has been controlled. The bullion banks play a game called arbitrage. When the price of silver spikes in New York because of heavy buying, the banks pull metal out of their vaults in London and ship it to New York to flood the market and cool the price down. When London runs low, they pull metal from COMEX-approved warehouses in New York and fly it across the Atlantic to refill the shelves. Back and forth, New York to London, London to New York. This constant flow creates the illusion of abundant supply. It smooths out volatility. It keeps the price from doing anything too dramatic. The technical term for this is fungibility. 1 bar in New York is treated as identical to 1 bar in London because you can always swap them if needed. But fungibility only works if movement is frictionless. If you introduce friction, say a 10% tariff every time you bring metal back into the United States, the whole system breaks. Here's the math. Let's say silver is trading at $90 an ounce. A bullion bank ships 1 million ounces from New York to London because London is running dry and the price is spiking. No problem, there's no export tax. But then, a month later, New York needs that silver back to settle contracts on the COMEX. Now that silver is being imported from the United Kingdom. Under the new tariff, the bank has to pay 10% on the value of the metal at U.S. Customs. That's $9 per ounce. On 1 million ounces, that's $9 million in tariffs. Just to bring back your own metal. In the razor-thin margin world of commodity trading, a 10% hit doesn't just hurt, it's unsurvivable. So the risk manager does the only rational thing. They stop moving the metal. Once silver leaves U.S. soil, it can't come back without destroying the economics of the trade. The border has become a one-way valve. Silver can check in, but it can't check out. This creates what traders call a roach motel scenario. You put something in and it stays there forever. And it's not just about physical shipments. It's about derivatives, hedging, and the entire structure of how these banks manage risk. Most major banks run a global book. They might be long silver in London, meaning they own it, and short silver in New York, meaning they've sold futures contracts. In a normal world, these positions offset. If the price goes up, they make money in London and lose money in New York, but it balances out. This is called hedging. It's how they avoid catastrophic losses. But hedging only works if the price in London and the price in New York move together. If a tariff wall prevents you from moving metal between the 2 cities, the prices can diverge. Silver could trade at $90 in New York and $120 in London. Suddenly, your hedge isn't a hedge anymore, it's 2 separate bets. And one of them is going very, very wrong. The banks now face a choice. Do they keep their silver in New York and let London fend for itself? Or do they ship metal to London, knowing it can never come back without a massive penalty? They can't do both. And because most of these banks are US-based or have significant US operations, they're going to protect the COMEX. They'll keep the metal in New York, which means London is on its own. Let's talk about what's been happening in London for the past 3 years. The LBMA has been bleeding silver, not slowly, relentlessly. The primary driver has been demand from India and China. These countries have been vacuuming up physical silver at a pace that the market wasn't designed to handle. The LBMA vaults, which once held hundreds of millions of ounces, have been drawn down to levels that analysts describe as critical. Much of what remains is already spoken for. It's owned by ETFs like SLV, or it's been allocated to institutional buyers. The amount of unallocated silver, meaning metal that's available to settle new contracts, is alarmingly low. For years, the LBMA has survived by calling New York for backup. When they ran short, they'd coordinate with COMEX-approved warehouses to ship metal across the Atlantic. But now that lifeline is cut. Because of the tariff, no rational actor is going to send silver from New York to London. So when the trading day opens on Monday morning in London, the people running the LBMA are going to be staring at a very uncomfortable spreadsheet. They've sold more silver than they can deliver, and the backup supply isn't coming. This is the setup for a localized default. Not a global collapse, not necessarily, but a situation where the London market simply cannot fulfill its obligations in physical terms. And when that happens, the price in London will do something it's not supposed to do. It will decouple from New York. You could see silver trading at $90 in the US and $110 in London, purely because the metal can't move between them. This breaks the concept of a global spot price. If there are 3 different prices in 3 different cities, which one is real? The answer is simple. The real price is wherever you can actually get the metal. Now let's zoom out and look at the second order effects, because the tariff doesn't just trap metal, it traps capital, it traps strategy, it traps the entire business model of the bullion banks. One of the less discussed mechanics of the silver market is something called location swaps. Instead of physically moving metal every time there's an imbalance, banks often trade ownership. A bank in New York might swap bars they own in New York for bars owned by a bank in London. On paper, everyone gets what they need. Physically, nothing moves. This works because everyone assumes that eventually the metal can be moved to settle the ledger without a cost penalty. But the tariff destroys that assumption. If you can't move the metal without paying 10%, you can't close out the swap. So banks will stop doing swaps. They'll stop taking on positions that require intermarket coordination. This reduces liquidity, it reduces flexibility, and it makes the entire system more fragile. Then there's the refiners. A lot of the silver that enters the US market is refined in Europe or Canada. It's turned into bars, rounds, and coins by facilities that have been doing this for decades. If the tariff applies to refined silver products, then the cost of importing those products just went up by 10%. That cost gets passed on to dealers, and dealers pass it on to you. So even if the spot price on a screen says $90, the price you actually pay for a silver eagle or a generic round is going to be significantly higher. Premiums, which were already elevated, are about to spike again. This creates a weird bifurcation in the market. There's the paper price, the number you see on financial websites, and there's the street price, what it actually costs to get your hands on the metal. The gap between those 2 numbers is widening. Here's where it gets genuinely dangerous. Millions of investors hold silver through unallocated accounts at LBMA member banks. An unallocated account means you don't own specific bars. You own a claim on silver that the bank says they have. It's essentially fractional reserve banking applied to precious metals. The bank doesn't hold a physical bar for every ounce you think you own. They hold a pool of metal and issue claims against it, assuming not everyone will ask for delivery at the same time. This works fine in a liquid, stable market. But if London is cut off from resupply and the market realizes that the LBMA can't get more metal, there's going to be a run. People are going to try to convert their unallocated claims into allocated bars. Real, serialized, physically segregated metal. And there aren't enough bars. So the banks will have to go into the open market and buy whatever they can find, at whatever price it takes. This is how a liquidity crisis becomes a solvency crisis. The price spirals because the supply physically isn't there. And the tariff ensures that no one can import metal from New York to save the day. Now, let's revisit something that happened right before the tariff announcement. On Friday, January 16th, 4.2 million ounces of silver were withdrawn from COMEX-approved warehouses. At the time, this looked like a major physical delivery. People assumed it was heading to London, or perhaps to Asia. But with the tariff announcement coming 48 hours later, it's likely that metal's now stuck. It was probably pulled in anticipation of export. But once the tariff was announced, the economics changed. If you're holding 4.2 million ounces in New York, and you know that shipping it to London means you can never bring it back without a 10% penalty, What do? You don't ship it. You sit on it, you wait. Or you sell it to a domestic buyer who needs it. Tesla, Raytheon, the US Mint. This means the domestic US supply might actually stabilize in the short term because metal that was supposed to leave the country is now staying here. But it also means the squeeze in London is going to intensify immediately because that 4.2 million ounces was probably the cavalry. And the cavalry isn't coming. Here's the part that almost no one is talking about. This policy, whether intentional or not, functions as a strategic resource lock. By making it economically irrational to export silver, the tariff effectively creates a domestic reserve. Silver stays in the United States. It stays available for critical industries. It stays available for defense. It stays available for the tech sector. It forces the global market, and specifically Europe, to fend for itself. This is, in a strange way, the most effective America-first mineral policy you could design. Not by subsidizing mining, not by building new refineries, but by making it too expensive to give away what you already have. The irony is that this wasn't the goal. The goal was Greenland. The tariff was leverage. But the effect on the silver market is more significant than anything a White House memo on critical minerals could have achieved. It's accidental industrial policy, and it's devastatingly effective,